The Sure Investing Podcast, investments and strategies to help you safely compound your wealth over the long run. Hi everyone. Today I'm excited to be interviewing Charles Fournier, a retired executive from the Canadian financial services industry who left the workforce in his mid-50s thanks to a high-quality portfolio of dividend growth stocks. He currently shares detailed information about his investment journey on his website, www.financialfreedomisajourney.com. In this episode, we discuss his investment due diligence process, his current holdings, and how Charles managed to engineer an early retirement primarily through investing in dividend stocks. Stay tuned for more. All right, well, Charles, I just wanted to begin by saying thanks so much for taking some time to be on the Sure Investing Podcast. We're really happy to have you.
Well, not a problem. My pleasure.
I thought we could begin by just asking you how you got started in the investing world and how things have changed since you began those years ago.
Wow, we have to go back to the horse and buggy whip era. So I started investing, back in the 1980s. I completed my MBA in finance in 1986, and that was after having worked for a major Canadian financial institution out in Calgary from 1980 to 1984. And, I guess unbeknownst to me, my parents had expected me that I would work for 4 years and then I would be going back for my MBA. And when they didn't hear from me that I was planning on going back, I got a phone call saying, "So what are your plans?" I was quite enjoying myself out there, and I really had completely forgotten that I had made any kind of commitment. I don't know if I ever did. I think it was probably just my parents saying that was the deal. So what I did was I went back to university and I got my MBA. And what attracted me to investing is I really could not envision myself working until I was in my 60s. I mean, I started thinking about how I could stop working almost from the day I started working full-time in 1980. So what I ended up doing was I kind of mapped out where I was and where I wanted to go. Let me back up a minute. Nobody wants to do equity investing. The reason you're doing it is because you want something out of it. It's just like when you go to a hardware store and you buy a drill. You don't want a drill. You want a hole. The drill is what is going to give you the hole. Equity investing was the route that I chose that I thought would help me achieve financial freedom. And, what I'm going to be saying on this call, people may not agree with. That's not a problem. I just chose equity investing to help me achieve financial freedom. Other people might do real estate investing. So what I did when I started investing, I determined my risk tolerance level. And before I even started investing, I said, 1, I can't have any debt, and I have to have a cash cushion. To me, it made absolutely no sense to invest in companies with the hopes of achieving some kind of return if I had debt and I had to pay out, I had to pay out from my cash flow with certainty, debt that was being charged, going back to the 1980s, it was double-digit rates. We had prime in Canada was probably around 14-15%. I said it makes no sense to invest in equities unless I have no debt and a cash cushion. And then despite me graduating with a degree in finance, an MBA in finance in 1986, I realized that what I learned was primarily from academics. So what I had to do was I had to start reading from people who had actually been successful equity investors. Sitting in the classroom and listening to professors, you learn You learn stuff, but it's not always real world stuff. So after working, I started working full time after my MBA in 1987, and I immediately joined the bank's employee share ownership program after my 6-month probationary period. So that was really my first experience with equity investing. And then what I also did was I enrolled in an investing with the Canadian Share Owners Association, which was started up by my wife's former introductory to finance university professor. He left academia and he started up the Canadian Share Owners Association. And it was great. You know, there was education involved there. But Nick, I don't think you were around before the advent of the internet. But back then, if I wanted to buy shares, I had to cut a check. I had to mail in the check with a form indicating what securities I wanted to buy. And there was only a handful of companies from which I could choose from. And not only that, but they stipulated when they were going to buy the shares during the course of the month. So if I wanted to purchase shares in BCE, that's Bell Canada Enterprises in Canada, you know, they would buy shares, let's say, every second Tuesday and every fourth Thursday of the month. And selling shares was not easy either. I'm laughing when I say the internet and how you probably haven't been around prior to the advent of the internet. But I remember starting to work in 1987, and we didn't even have a fax machine at the office. Eventually, when we got a fax machine, you know, we had to use a roll of paper on which the ink would fade over time. So we had to actually photocopy faxes to save them, and then we had to ask clients to courier the originals to us. So I'm talking dark ages here, and I know there's probably going to be some listeners who are going to say, dark ages, I go back even to the 60s and 70s, but to me, that was the dark ages. I also invested a little bit of money in mutual funds, but I didn't have a whole lot to invest at the time because, you know, one of the priorities that my wife and I had was to pay off our mortgage as quickly as possible. So we didn't want to be paying a mortgage in perpetuities. So, all the free cash flow that we had went toward the repayment of the mortgage. So I had a little bit of money in mutual funds, but I wasn't overly enamored with it because of the fees. You know, there were deferred sales charges on some of these mutual funds. It was on a sliding scale. But if you invested today and wanted to take your money out, let's say in a year's time, they would charge you a 5% fee. And it was only after you held the mutual fund for, let's say, 5 years that there was no longer a deferred sales charge. So I really wasn't wild about mutual funds. So that's how I got started investing in the dark ages.
Now, you mentioned that you are not overly enamored with mutual funds. What are your thoughts on other passive investing products like exchange-traded funds or other more complex products? Do you own any of them? Or do you think there's a place for other investors to own them in their portfolios?
I think there's a place for exchange-traded funds. Personally, I don't have any mutual funds. I only have like about $1,000 in an iShare Global Energy Exchange Traded Fund. That's the only ETF that I own. But for some investors out there who may not feel comfortable in individual stock picking, or if you don't have a whole lot of money, probably the best way to get going is in an ETF. Like in the last couple of months, I had a friend of mine who indicated that his 19-year-old son had accumulated about $8,000, and he wanted some suggestions as to where his son should park the money. And his son had identified these 2 or 3 companies, and he was thinking of putting his money in there. And I said, well, these companies that he's identified, they're pretty speculative. What you don't want your son to have is a terrible experience from the get-go. Why don't you just go in a broad-based ETF? You'll have a basket of stocks. That's probably the best way for him to start off. Personally, I prefer to analyze companies and pick and choose the ones that I want to invest in. When you take a look at a lot of the ETFs, like let's say the S&P 500 ETF, if you actually look at the composition, the top 30 stocks probably comprise a fairly sizable proportion of the total ETF. I don't speculate. I like to go for companies where I can put my head on the pillow and sleep well at night. So I figured that out of those 500 companies in the S&P 500, for example, I figured I could probably analyze a few and find some really good companies. And so I've decided that I don't do mutual funds, I don't do ETFs, and I just wrote a guest post for Sure Dividend where I wrote about the shotgun approach and the rifle approach to investing. I use the rifle approach, which is something that I've learned from, Warren Buffett and Charlie Munger from reading countless books about them. That's my approach. And there's some listeners here who might prefer the shotgun approach. To me, the shotgun approach is like taking mud and throwing it against the wall and hoping some of it sticks. That's just not me.
For people who haven't had the pleasure of reading that post, would you mind elaborating a little bit on what the differences are between the shotgun approach and the rifle approach?
Sure. So the shotgun approach is where there's so many companies out there. And when I first started investing, I saw all these companies and I wanted a little piece of the action of all of them. So what I would do was I would go out and I'd buy, 1 or 200 shares of company A. And then I would accumulate a little bit more money and then I'd buy 1 or 200 shares of company B. And I would do that. And then eventually what happens is, you have a basket of stocks, but you don't have a whole lot of money invested in these stocks. So you're getting all these little drips and drabs of dividends that are coming into your account. And there's usually not enough dividend to be reinvested to acquire another share of a company. So I did the shotgun approach for the first little while. And then when I realized that I could properly analyze companies, I decided that I would focus on just a few companies. So if you read that post, in there, I list the top 10 stocks that we have in our portfolio. So, altogether, we have about, I guess maybe somewhere around 50 shares in 50 different companies. But the top 10, we have about 53% of our investments in the top 10 companies. And those companies, they're Visa, Bank of Nova Scotia, that's my former employer, 3M, Royal Bank of Canada, Church and Dwight. For people who aren't familiar with Church and Dwight, I just wrote a post about them on my site. They're the Arm & Hammer Trojan condom folks. Johnson & Johnson, Chevron, Walmart, Canadian National Railway. Backing up, I just bought a couple hundred additional shares at Church and Dwight. And Canadian National Railway, I just bought another 400 shares in Canadian National Railway, I think on January 26th. And then we also have Canadian Imperial Bank of Commerce and Becton Dickinson. Now, with Canadian National Railway, the way I look at it, I look for companies with wide moats and sustained competitive advantages. And if you look into Canadian National Railway and you look at, their tracks, they run from, the East Coast to the West Coast in Canada, and then they go through the Midwest in the States. So they have pretty good coverage. And, when you think about it, back in 1980, there's three different classes of railroads. You have class 1, 2, and 3. Back in 1980, you had, I think there was 40 class 1 railroads. Now you're down to 6 or 7. So you'll have Canadian National, Canadian Pacific, Union Pacific, Norfolk Southern, CSX, and Burlington Northern. That would be another one, but Berkshire Hathaway bought that outright. Becton Dickinson, the last one that I mentioned in the top 10, super company. Your listeners should, however, take into consideration that Becton Dickinson has changed considerably in recent years. So, their credit rating used to be AA. 2 or 3 years ago, they bought CareFusion, and then just recently they closed the acquisition of C.R. Bard. So now, S&P and Moody's, the credit rating for Becton Dickinson is non-investment grade speculative. So if you're going to buy Becton Dickinson, great company, but just be aware of its credit rating. Now, management has indicated that the game plan is to get their credit rating back to BBB within the next 3 years or so. So that's the top 10: Visa, Scotia, 3M, Royal, Church & Dwight, Johnson & Johnson, Chevron, Walmart, CN, CIBC, and Becton Dickinson. What I didn't mention in my article is the next top 10 are TD Bank, ADP, MasterCard, Exxon, AT&T, Total, UPS, BCE, PepsiCo, and JM Schmucker. So I think all your listeners will probably recognize, if not all of them, probably 17 to 18 out of the 20 of them. So those are the types of companies that I go for.
One name that surprised me from that list is Total. Would you mind elaborating on your investment thesis there?
So I bought Total ages ago. In hindsight, probably not the wisest move because it's an American deposit receipt. And so Canadians get hit really hard from a tax perspective on American deposit receipts. I just bought it because it was another giant, oil and gas giant. I bought it when the price was depressed. A lot of these stocks I bought when the financial crisis was happening. So what I had done was I was extremely nervous back in 2007. And this is something that is totally out of character for me, but I liquidated a huge component of our portfolio in 2007 and I sat on cash. And, I kept hearing rumblings about, what was happening south of the border. And so I built up some cash. I bought Total when it was really low. I liked, I knew I was going to invest in Chevron and Exxon, and I was looking for a number 3. Why did I not buy Shell or BP? I don't know. Maybe you can answer it for me. I really don't know.
All right, thanks for giving some color there.
Yeah. Let me back up. I just want to mention something about 2007 when I liquidated a huge component of our portfolio. We happened to be on holidays down in Florida, and I met a couple, and their daughter was playing at the pool with our daughter, and this guy had taken over his mother's appraisal business. I think it was in Ohio or whatever. And he said, I'm going to check out some properties down here. I'm thinking of investing in some real estate. Do you want to join me? And I went, no, I'll pass. The next day I meet him at the pool. I thought he was going to buy 1. He bought 3. So here's a guy whose income was derived from the real estate industry, and his investments were in the real estate industry. I don't know the guy. I've never met him again. I just don't think things panned out too well. But I was just seeing all sorts of crazy stuff in 2007. So that's why I did something that was totally out of character.
Interesting. That man's mistake is clearly putting his eggs all in one basket. You know, his active income was derived from the same place as his passive income, which is dangerous. With that in mind, what would you say are the top 3 investing mistakes that most investors make?
Not knowing what they're doing. I think it's important that people learn how to properly analyze companies before they start investing in companies. I think what happens in a lot of cases is people go online and they look at stock screeners. And over the last few years, I would strongly suspect that a lot of investors out there have been chasing yields because, the typical yields that they used to derive from, term deposits and GICs just went down to basically nothing. So they started turning to companies that were yielding north of 6-7%. You have a coin, on one side is risk, the other side is return. If you see something that is going to generate a double-digit yield in this low interest rate environment, you better stop and think before you make that investment. So one, I think, people have been chasing yield. They haven't been doing their research. They do their stock screeners and then they look, for the highest yield. I think also what happens is flavor of the day. So you read a lot about people going into cryptocurrencies and in Canada, it's like the marijuana stocks, flavor of the day, and people employing the use of leverage. You can go online today and read stories. Like within the last 2 or 3 days, I was reading stories about, people who just blew their brains out because of this recent correction, and they were employing leverage. So that's a mistake that I see. The other mistake that I see a lot is people don't have a cash cushion. If I look at our cash flow the same way as I look at a company's cash flow, I look for free cash flow. If you have a car loan or a lease, and you have credit card debt, and then you have student loans, and then maybe a mortgage payment or a rental payment, get rid of those things before you start investing.
You mentioned that one of the big mistakes is people not knowing what they're doing when they're buying stock. I was wondering if you had any suggestions for listeners who are looking to develop their knowledge of how to analyze stocks.
You guys at Sure Dividend have a couple of great courses on your site. So I'm not trying to, flog your course or anything like that, but I've looked at the courses. You had asked me to review the courses before you went live with it. Anybody who is not totally familiar with how to analyze financial statements, I strongly suggest they check out your courses. It's a small price to pay. In the grand scheme of things, before you start investing thousands of dollars, invest a few $100s in yourself. Learn what the heck you're doing before you start investing. The other thing is read, and read some more. I'm the type of person where my eyes glaze over when I read really technical books. So I made a list of a few books that I read, I got something out of it, and the content of the books actually kept me captivated. And there's a little bit of humor in some of them too. So the first one I'd like to mention to your readers is Damn Right, which is Behind the Scenes with Berkshire's billionaire Charlie Munger. A lot of your readers may have also read The Snowball. That's Warren Buffett in the Business of Life. That the author is Alice Schroeder. Charlie Munger, The Complete Investor, by Trent Griffin, Tap Dancing to Work, which is Warren Buffett on Practically Everything, and that's by Carol Loomis. Creating a Portfolio Like Warren Buffett, a High Investment Return Strategy, and that's by Jeeva, Jeeva Ramaswamy, Ramaswamy. Warren Buffett on Business, Principles from the Sage of Omaha, by Richard Connors. Are you detecting a theme here? There's a lot of Munger and Buffett. Poor Charlie's Almanac, Peter Kaufman. The Dhandho Investor, that's Dhandho, the Dhandho Investor. It's the Low Risk Value Method to High Returns by Monish Pabrai. Daring to Succeed, Guy Gendron. So he is the founder of Alimentation Couche-Tard, Circle K. And right now I'm reading The Breakthrough Company by Keith McFarlane. The other thing your readers might want to look at is, and a lot have probably already done this, you go on YouTube and you look up Charlie Munger and Berkshire Hathaway or Monish Pabrai and listen to some of the talks that they give to students at various universities, and you'll learn a lot from them. Some people love things like The Intelligent Investor. I'm sorry, Nick, but my eyes glaze over when I read that.
It's funny you mentioned that book because it's widely touted as one of the best investing books of all time, but I personally think it's quite a bit overrated.
Yeah, and I know Warren Buffett has probably read this thing like 20 times or so, but his personality is very different from mine. I can't sit there and read more than 10 pages at a time. And even then I start to lose interest.
Yeah, definitely. The book is certainly monumental in the sense that it introduced many philosophical pinnacles of the investing world, like Mr. Market and margin of safety and those sorts of things. But like I said before, I've personally found it to be a little bit overrated.
Yeah. It's a great book and a lot of people love it. So, if you want to, for those who haven't read it, check it out and you make your own decision. I just want to go back to some of the other, you had the question about, what are some of the things that people should maybe do before they start investing. And I was talking about like, don't chase yield, don't chase flavor of the day. Tune out the noise. Unless you enjoy some talking head yelling at you and pressing all sorts of buttons that make weird sounds, stop watching those shows on TV. Unless you enjoy it. But these types of shows, it's all about where's the market going today, where's it going tomorrow, and where's it going next month. Focus on where is the company going to be 5 years down the road, 10 years down the road. The other thing is, and I know there's people out there who love these types of companies, it's not for me. So I'm just giving you my take on what I do, but I avoid business development corporations, master limited partnerships, REITs, and closed-end funds. I avoid them like a plague. The reason being is all the money that they generate gets paid, or not all of it, but a big chunk of it gets paid out to the unit holders. So if you're going to grow, you have to raise debt or issue more units. And if you drill down into some of these entities and you look at what is being paid out to you, it's not always a return on capital. In some cases, it's a return of capital. And these types of entities have attracted a lot of people because of their yields. But I suspect that as interest rates start to creep up, some of these entities will suffer. I'm not saying, they're all bad. There's probably some great ones out there. I have not analyzed all of them. But I go back to Buffett and Munger. Do you think they invest in this stuff? Not a chance. They don't invest in this stuff. And, why would you want to invest in companies that distribute most of their free cash flow? You want companies that are using their free cash flow to the best advantage of the shareholders. That's either acquiring new entities, paying down debt, increasing dividends, repurchasing shares. If you are one of these MLPs and you're paying out most of your free cash flow, how do you grow? So, and then another thing is, I came across, this is what Buffett had said to since at least the 1990s when he was visiting college students and giving advice on how to get rich. He said, if I could improve your ultimate financial, and I'm quoting him verbatim, if I could improve your ultimate financial welfare by giving you a ticket with only 20 slots in it so that you had 20 punches representing all the investments that you got to make in a lifetime. And once you'd punch through the card, you couldn't make any more investments at all. Under those rules, you'd really think carefully about what you did, and you'd be forced to load up on what you really thought about. So you'd do much better. So I ask you this, when I was telling you about the top 10 holdings that we have, like Visa and 3M and Johnson & Johnson and Walmart, what would possess somebody to invest in BDCs and MLPs instead of those types of companies that will probably still be around long after I'm gone?
On the topic of long-term investing, what's your longest held stock right now?
I remember when I was very young, I don't think I was even 10 years old, my mother brought me to a BCE annual shareholders meeting. I had no idea what was going on. I just went into this room and saw all these people. That's all I recollect. But my parents bought me some Bell Canada Enterprise shares way back in the early 1960s. Other than that, honestly, I really don't know which is the longest because I'm going back to, the oldest statements that I have. And the oldest statements that I have show, I had 3M, ADP, ExxonMobil, the 5 major Canadian banks, Walmart, and Johnson & Johnson. But BCE, if I have to go back to the 1960s, I still have those. The other thing is, slightly off topic, but going back to when I said, don't chase yield. I'm not yield hungry. I have a lot of shares in our portfolio where the yield is sub 2%. But I think something's working out okay because I keep track of the dividends that we get every single month. And then what I do is I compare it year over year to see how things are progressing. And just the other night before, when you sent me the questions that you wanted to ask today, I thought I would bring this up. In 2007, our portfolio generated about $9,267 in dividends in 2007. By 2012, it was generating $31,852 in annual dividend income, and now it's generating 6 figures in annual dividend income. And I don't have 8, 9, 10, 11% dividend yielders.
All right, the last question I asked you was, what's your longest held stock? I'm curious if I flip that question and say, if you had to buy one stock knowing that you were never allowed to sell it right now, what stock would it be?
Visa. Number 2, MasterCard. These guys, I had one of my former team members went to India in November and December. And when he came back, I was speaking with him, and he said, Charles, you're not going to believe this. I was in the middle of nowhere, India, and street vendors weren't accepting cash. It was all mobile payments. you wanted to buy bananas, you paid them with a mobile payment, and it funneled through, either a Visa or a MasterCard network. If I could, I would buy China's Union Pay, but it's not publicly traded. But Visa and MasterCard, they're technology companies that just facilitate the flow of money. And when I was working, the Visa flow of funds used to go through our bank. We were the bank in Canada through which all of Visa payments flowed, big numbers, and it keeps growing. It's not going to shrink, and when you take into consideration that they get a little sliver out of every payment that goes through the system, you take into consideration inflation. So you're going to buy something today for $1. I'm willing to bet you that 10 years from now, that product or service will be more than $1. It might be $3. So Visa's just naturally going to benefit from the increase in prices due to inflation. So Visa number one, MasterCard number two.
Let me ask you the opposite question now. Is there any particular part of the stock market, whether it's an individual company or a sector or a trend, that you are dead set on staying away from right now, other than the aforementioned REITs and MLPs and those unusual corporate entities? If you have to stick with corporations, what are you avoiding right now?
I shy away from the mining sector and the real estate sector. And the reason I do that is I remember from my banking days. So I used to head up the corporate cash management team, or one of the corporate cash management teams at a major bank in Canada. And our partners were the corporate bankers. And what I noticed was the corporate bankers in mining and in real estate, they very rarely moved from that industry to another industry. It took years and years to become really knowledgeable in those sectors. And I don't have the knowledge that those folks have. But I saw corporate bankers that would move from, consumer products over to, I don't know, let's say industrials. I saw that transition, but I just think it takes a lot of knowledge acquired over several years to become truly knowledgeable when it comes to mining and real estate. The other thing is I find that those two sectors are probably more cyclical than I can stomach.
Would you say that there's any sector of the stock market that's kind of the opposite, in the sense where investors can safely park their money there and really sleep well at night without worrying about it?
I think it's important that you always be vigilant because there's so many disruptors out there. So I could talk about like UPS and FedEx. Amazon is encroaching into their space. So you can't just say, I can park my money in this company, in this industry, and not worry about it at all. You always have to be vigilant. But if I did have to choose a couple of sectors, or do you want sectors or companies? Because there's a few companies out there that I think will be long-term holds for me. And that would be, like I talked about, Visa, MasterCard. Then you have Canadian National Railway, and then Union Pacific. And then there's another company that I am in the process of analyzing right now. So I won't mention the name because I'll probably have a post going up on my site shortly. But it's a spin-off from ADP. So those are the companies. So you're looking for companies with wide moats, sustainable competitive advantages, and deep pockets. And other great companies would be like Johnson and Johnson and Microsoft, and I don't go down market to the $1 and $2 billion companies.
Now, in terms of key metrics, when you're analyzing a company, what are the things that you consider to be the most important?
Free cash flow is number one. So I like free cash flow. You know, you, I think in my recent article I mentioned something about revenue being vanity and profits being reality, but free cash flow is sanity. So I I like I like free cash flow. Return on equity, I know a lot of people look at that, but that can be somewhat misleading. And I know there was somebody recently who sent me an email, and I found an interesting article as to how companies can manipulate their ROE. So I don't focus entirely on that. I look at um, you know earnings per share, diluted earnings per share. I look at leverage ratios, interest coverage. Um, I look at what is the company doing as far as share repurchases. So I look at the weighted average number of shares outstanding, basic and diluted, and over the last few years, and you're probably well aware of this, there's companies out there that have been borrowing billions of dollars to repurchase their shares, and that inflates the stock price. All of a sudden your earnings per share go up dramatically because you're buying back all these shares. But I can't help but wonder what's going to happen down the road when these companies have to start repaying that debt. What if interest rates aren't as low as they are today?
I guess at that point, only cash will do the trick.
Exactly, and you just better hope and pray that they're still able to generate tons of free cash flow. And who knows what the environment will be like, you know, 15, 20 years down the road, because a lot of this stuff is long-term debt. So I'm thinking of, a company like Home Depot, for example. I'm not saying Home Depot is not a good company. I'm just saying I think it was last year where the board approved a $15 billion buyback program. And, so Home Depot they don't have $15 billion kicking around to buy back all these shares. So they're going to have to borrow it. And at some point in time, companies can't always be going to the well to borrow money to buy back the shares. Otherwise, the credit rating agencies are going to downgrade them. So that's just my take on things. I might be totally out to lunch, but I'm very wary when I look at companies buying back tons of shares with debt. That's why I always look at, the credit ratings and the trend of the credit ratings and whether they're on the rating agency's watch list for, possible downgrades.
Your emphasis on credit ratings is something that really stands out about your investment style. And I mean, as you know, there's only two companies right now that sport that coveted AAA credit rating from S&P. It's Johnson and Johnson, which I know you own, and Microsoft, which I suspect you probably own as well.
Yeah.
If you had to pick a third company to join that list of two, who would it be?
Wow. Well, I like Visa, but I'd really have to sit back and think about it. I'd say Visa.
Interesting. I have to say Visa is a company I haven't analyzed in any detail, and I had no idea that their balance sheet was that strong.
Well, what I like about them is they have, it's the type of company that is highly unlikely to be displaced. And there's huge growth potential in the upcoming regions of the world. You think about Visa being used in Europe and North America, but you go to places like Nigeria and India and, Kazakhstan, people are starting to use Visa services out there. So there's, I think, huge growth potential for Visa. And, they don't take on any credit risk. They don't take on your credit risk and my credit risk. They just move the money. I'd have to give more thought, but off the top of my head, I just like Visa. And I think I've mentioned this to you before. It's one of those companies where I never really want to sell my shares. I just take a look at, I bought Visa shares shortly after the IPO, and I look at the return that I've generated on it. You never want to fall in love with a stock, but it sure is hard not to fall in love with Visa.
Yeah, it sounds like one of those buy and hold forever stocks for sure.
Yeah.
So, I mean, we're kind of getting overtime here. I thought I'd ask you one last question before we wrap things up. And the question is this. If you could give one piece of advice to an investor who's just starting out today, what would it be? Invest in yourself. Learn. Read. Don't jump into the market and start investing. Take a step back. Talk to successful investors. Don't talk to your friends. The reason they're your, the last thing you want to do is talk to somebody who's in the same boat as you. So if you can, find somebody who is successful at investing. Educate yourself. And I mentioned earlier in the call, check out the Sure Dividend courses. They're really easy to follow. They actually have screenshots of financial statements, and it shows you where to look to find out the details, to calculate various metrics to determine whether a company is, financially sound or not. They'll show you how to calculate, the current ratio, the working capital, the cash flow, and all that kind of stuff. That's important. And the other thing too is, I know some people, their eyes will glaze over just like my eyes glaze over when I read The Intelligent Investor. But, pick up an annual report and don't just read the glossy stuff at the front. Look at the 10Ks. The 10Ks, the notes to the 10Ks. If you start reading a 10K for a financial institution, it's really complex. But if you start reading a 10K for a company like Fastenal for example, it's relatively easy to understand. Go on the company's website. Listen to conference calls. Look at the investor presentations. It's all about knowledge. So learn how to read financial statements and then actually go on, a couple of companies' websites and look at real live material. Awesome. That's all advice that I echo very strongly. Thanks a bunch for your time today, Charles. I learned a lot talking to you, and I think that most of our listeners are going to be able to say the same thing. So thanks. Oh, you're very welcome. Thanks so much for listening to today's episode, everyone. I invite you to check out our website at sureinvesting.co, see our premium investment research at suredividend.com, and also check us out on YouTube where we publish videos under the name Sure Dividend. See you next time.